You're listening to The Moose and the Loose, your 10 minutes action-packed financial podcast with your host, Mikey Hu. Hey, what's up, Market Moose? Mike from The Moose and the Loose. Happy Wednesday. So this week we are looking at my 5 most important investment rules. On Monday, we talked about the dividend triangle. On Tuesday, we talked about the fact that you have to write down your investment thesis, so the reasons why you want to invest in a company, and then you have to make them work with financial metrics. So the dividend triangle, the financial metrics must back your investment thesis. So if you're thinking that the company is growing well, you should expect to see revenue and earnings grow. So those are like the first 2 rules. And then today we're going to and those 2 rules are like most likely used to buy and monitor. So whenever I want to invest in a company, it must have a strong dividend triangle and a very interesting thesis. And most importantly, I must understand what the business is doing. So understanding the business model, understand why I own it and what I own and why I own it is super, super important in the buying process. Today, we're going to talk about a little bit more about the selling rules. Yes, you invest in thinking in decades, you invest to hold those stocks forever, but unfortunately, things change. I'm not the same person I was 20 years ago, and none of my business as well. So it's important to have rules to say maybe today is the time to let it go and to move on. Actually, Todd, one of my dividend stocks rock members, like the other day we were talking together, and he said, building a portfolio is like managing a hockey team or any like sports team. Is you have to constantly looking to draft new players, as some players will have to retire. So at one point, we all wish that Sidney Crosby would be on our team forever, but the guy, he's getting older and older every year, right? And in 10 years, I can guarantee you that, even though he has a very strong longevity, in less than 10 years, he's not going to be an NHL player anymore. And you have to find a replacement. So you always have to look at other companies. And then most importantly, you have to know when it's the right time to let Crosby go, even though you fell in love with the player. With stocks, probably a little bit easier to get rid of them because, it's not like you will like wear a t-shirt of your favorite companies, but still not really easy. Hence, having investing rules. So as you can imagine, I only have like three selling rules. Super easy to sell stocks. Actually, a lot of people struggles with that. I keep things simple. The rule number 1 is actually linked to yesterday's episode, so I strongly suggest that you go and have a listen. Is the day that my investment thesis and the financial metrics are not aligned together, it's time to determine a time frame and let it go. I explained that also on Monday with Couche-Tard. Alimentation Couche-Tard, the dividend triangle is slowing down right now. I will give it 3 years. So already 1 year has passed. There's like 2 more years. So in the next 2 years, I will follow management, what they do. And if the dividend triangle is not back on track, I'm going to let it go. And then I'm going to cash a good profit on it. And I'm going to be happy. So investment thesis must match the financial metrics. If not, you put a time frame and then you let it go. Of course, those are like not financial advice. You can build your investment the way you do your investment rules the way you want. And if you want to be faster than wait 2-3 years, it's up to you. I'm not here to tell you what to do. I'm here to share what I do. And you're the judge if it works for you or not. Rule number 2, sell on dividend cuts. Like that's it. That's the rule. Like you announce a dividend cut, you're out of my portfolio and I move on. Like super easy, super quick, fast to take action. And of course, you take the loss. You take the loss when you do that. And I know a lot of people, they are tempted to say, well, there are exceptions. Sometimes the company will come back. It's not a good time to sell when there's a cut. You're losing if you're selling, all of that thing. All right. But here's the thing. you may remember like one or two great companies that made a comeback, and that happens. But usually when there's a dividend cut, you have to ask yourself like why a company would cut their dividend. Not to create a buy opportunity. That's not the reason why. They cut the dividend because as a last resort because the company is struggling. So when you're holding a struggling company in your portfolio, you're most likely gambling on the fact that the company can come back. So are you investing or gambling? Like, or you're simply hoping, and hoping is not an investment strategy. So hoping that 5 of your dividend cutters in your portfolio are eventually going to come back, maybe one, maybe not. And that is, it's not enough. It's not enough. Like, and then you get stuck into that paralysis by analysis. You attack your confidence, your conviction as an investor, because every time you open your brokerage account, you see those red lines. You think about those, and it's not good for your overall strategy. And some people will say, well, Mike, we can wait. Like, that's the whole point. Okay, so let's take a really, really good example, because Manulife is like one of like the favorite life insurance companies as of late. And of course, it's always related to short-term price performance. Manulife over the past 12, 18 months have been going up like crazy. So amazing investment. And then a lot of people will say, well, see, Manulife is coming back. Finally. Okay, yeah, finally. Do you remember that Manulife used to trade around $35 in 2008? That 16 years ago. 16 years. Financial crisis happens, they cut their dividend, and then they are in the penalty box for a full 12 years if you count the dividend. Because of course, Manulife pays a dividend even after cutting in it. So to be fair, you look at the total return instead. And to come back to zero for your investment between January of 2008, you have to wait until right before the pandemic in 2020, 12 years to recover. Was it worth it? I don't think so, right? And even with this crazy jump right now, if you have just invested in XIU following TSX 60, like, so nothing fancy, between 2008 and 2025, XIU, including the dividend, up 214%. Manulife, up 133. So almost 100% difference in returns. So just to illustrate that most of the time, not the good thing. Should you come back at one point? Maybe, but you should sell. I mean, I will always sell on a dividend cut. It doesn't mean that I will discard the company forever. A good example in my portfolio, National Bank is one of my favorite company in my portfolio, and they cut their dividend in the 90s. So yes, you can come back. And of course, Manulife today is not the same company than Manulife 15 years ago. So it is worth looking back at some companies as they grow back and they come back. But Manulife between 2008 and 2015, there was no point of holding this one. I mean, it took 12 years to recover. I have to highlight that. So sell on the dividend cut, move faster, increase your conviction, make it easy. It makes a lot more sense, and focus on dividend growers. To help you focus on dividend growers, I actually have the Dividend Income for Life guide that will explain you why it's so important to focus on the dividend growth instead of the yield. You can download it for free at moosemarkets.com/income. So moosemarkets.com/income, and you will see, backed with real life examples, how focusing on dividend growth is a lot better than focusing on the yield. And it's a lot riskier actually to thinking about the yield. So just to highlight this, there's a dividend cut. The company is not doing well, and it's not going to do well for a while. Time to move on and invest your money elsewhere. The opportunity cost is huge. Finally, I have a third rule. Yeah, even though I have like 2 minutes left on the podcast, I have a third rule. Super easy. It's more related to diversification and portfolio management, though. The rule goes like this: maximum 20% per sector of all my portfolios together, of course, not just one account, but all my accounts together. I can easily do that at DSR. I have like all my portfolios at Dividend Stocks Rock, and I can create a combination I want. So I can look at my accounts, I can look at my accounts plus my spouse, I can look at my spouse separately. I can create all the combination I want, and I see like if I'm overweight in the sector or not. So 20% and then maximum 10% in one single position. So the sector rule, that's more like of a guideline. So if I'm at 25%, I'm not going to freak out. yes, I'm gonna take a second look at the stocks that are in that sector, making sure that they're not in the same industry, not the same business model, just to make sure that I'm well diversified. But I'm not necessarily going to automatically sell. I'm just going to note that I'm overweight in a specific sector and monitor the situation a little bit more. And if I have to trim at one point, probably I'm gonna start with that sector. It's not to go crazy, but of course, if I'm at 30%, then I'm gonna start looking seriously about cutting a little bit of those companies, because then I would be too exposed to a single sector. The 10% weight of one stock across all my portfolio, this is a hard rule. This is a rule where I let my winners run up to the point they are so big that they are 10% of my portfolio, because I am not willing to lose more on one bad single idea. So I'm thinking, well, the maximum that could happen, like a dividend cut or something like that, I could lose 50% of the stock value over a short period of time before I sell and then cut my loss. So 50% of a 10% position, that's a 5% hit on the entire portfolio. I don't want to go higher than that. Some people will say, well, I don't want to lose more than 3%, and therefore the rule would be maximum 6% of a stock across all the portfolios. So that is a hard rule for me, but not necessarily the one that you should follow on your side. It's just to protect your portfolio against yourself. If you fall in love with your Crosby, as I said, and the Crosby is not able to score anymore and he costs $10 million a year, well, maybe you're not building the right team right now and you're probably not going to win the championship. So this is what you have to think when you build your portfolio and you manage along the way. So 3 simple rules. Rule number 1, investment thesis must be backed by financial metrics. Rule number 2, sell on dividend cut. And rule number 3, maximum 20% per sector, maximum 10% per stock. So more about portfolio management. So, all right, Moose, that's enough for today. I hope that you have enjoyed this podcast. If you did, please go to Spotify or Apple Podcasts, give me a 5-star rating. This is how I can get a little bit more popular, share the wealth, share the knowledge with more people. And this is the goal of this podcast. Tomorrow, we are closing in with 2 more rules about investing. That will be interesting to see how I manage my portfolio now that I have settled those base importantly. And until tomorrow, don't forget to stay invested. Hey, welcome to the disclaimer. If you're listening to The Moose and the Loose, you cannot really expect me to give you buy or sell recommendation or financial advice, right? You're here for fun, you're here for information and some entertainment. But I am not your financial advisor, I am not your broker, so therefore I'm not liable if you're losing money after listening to the podcast. If you're looking for some advice, go see a professional. If not, you can enjoy this show and do your due diligence after it.